Welcome to Private Asset Management's Week in Review. Today is Friday morning, July 15th. I'm Dillon Hakes. I'm once again joined by our Chief Investment Officer, David Allen. David, a mixed week for markets this week.
Absolutely. Good morning, Dillon. We did have a bit of a mixed week, but we're certainly ending on a high note here on Friday morning.
Speaking of the strength today, what's driving that strength in markets?
So we see it's actually a couple of economic reports that came out this morning. The primary one being the retail sales report, where we saw headline retail sales accelerate to 1%, and actually the May data was revised up to just a 0.1% decline. So those are both moving in the positive direction. This suggests that perhaps consumers at this point in the recovery are not necessarily growing as strong as we saw earlier, but not consistent with a recession here in the U.S.
What was the other report that we got some good news out of?
The other report that we think that the market is receiving positively comes from consumer sentiment. We didn't get a big change in overall consumer sentiment, but that report also includes some data on consumers' long-term inflation expectations, which actually fell in this report. That's a good sign from the Fed's perspective and perhaps gives them a little bit more leeway to ease their pace of policy tightening in the second half of the year.
The other big report that came out this week on Tuesday, talked a lot about in the news, was the June CPI report. What did we learn?
So in June, it looks like consumer prices accelerated once again, based mostly on food and energy prices. We saw headline CPI year over year accelerate to 9.1%. That's the fastest pace of growth since 1981. Underlying that, as I mentioned, it's mostly food and energy prices, but there's also some concerning accelerations in shelter prices as well as new and used vehicle prices.
Though the CPI report did seem a bit high this month, one of the things that's countering that we've been seeing in markets is commodity prices across the board and broadly have been coming down dramatically in recent weeks. How do we square those two separate signals?
Right, so it's basically a lag in the data. So there might be some time before wholesale energy prices, wholesale agricultural commodities, before lower prices there begin to trickle into what consumers are seeing. But as I mentioned, most of the CPI growth in June did come from those two categories, food and energy. And so as those lower prices filter through to consumers, we should expect some slower inflation later on this summer.
It's obviously encouraging that we have some potential for inflation to come down later this summer. How is the Fed going to react to this? What is the Fed's next move?
So the Fed's next move does come in 2 weeks when we have the next FOMC meeting. They're going to be taking in all the data that we have up to this point and any data that comes in between now and then to make their decision. We expect that they're going to increase rates by 75 basis points at that meeting. Moving past that, certainly if we continue to see inflation slow, it suggests that the Fed might have a little bit more room to slow the pace of tightening, perhaps not increase quite so quickly or quite so far over the second half of the year.
The other big news this week locally to our office was our big quarterly economic outlook and market update meeting we had earlier this week. The research team, you guys have been working hard on updating your financial projections for the third quarter. What are some of the broad highlights of what we learned, what we updated going forward?
Right, so our quarterly outlook meetings are something that the research team really focuses on at the end of a quarter and the beginning of the next quarter. We did update our outlook for both economics and financial markets here in the U.S. On the economic side, we presented some data that suggests that the U.S. economy isn't currently in recession, though that's the belief of some people out there. But we did present that we think that the U.S. economy is going to see slower growth in the second half of the year than what we saw in the first half, most of that due to a slowdown in consumer spending.
How does that flow into our projections for markets and for the type of investments that we want to make?
So on the equity side, it means that if we're expecting to see slower growth in the U.S. economy, particularly from the consumer, that perhaps we should begin to position our portfolios a bit more defensively in the second half of the year. On the fixed income side, though, it suggests that slower growth means we might not get the same level of interest rate increases from the Fed that we anticipated just a couple months ago. And so that suggests that perhaps there's an opportunity to take a bit more duration in our fixed income portfolios. But again, if we're expecting slower growth, we want to reduce risk in our fixed income portfolios also.
The other piece of news this week on the lighter side, we heard from Elon Musk and his bid to acquire Twitter actually backing out of the deal, Twitter filing a lawsuit. What's going on that side of things?
We can always count on Elon Musk to provide a bit of entertainment amid some of the more serious market and economic issues that we're analyzing. It does sound like he has some buyer's remorse as it relates to his acquisition of Twitter. He's committed paying top dollar for what's now a pretty depressed asset, so I think we can relate to that. Their disagreement is going to be heading to court now, so we will have to wait and see how the court process works out.
All right, David, what do we have on the agenda for next week?
So it's actually a pretty light week in terms of economic data. So most of our focus will be on equity earnings. We're in sort of the opening stages of earnings season, so we'll be following those very closely over the next week.
Thank you for joining Private Asset Management's Week in Review. We'll see everybody next week.